Good afternoon, dear students, alumni and guests. My name is Professor Grzeszczak, and on behalf of Warsaw University of Technology Business School, I would like to warmly welcome you to today's inspirational lecture. I want to welcome students and alumni of our university, Warsaw University of Technology and our business school, and also guests of our partners. Polimi Graduate School of Management, Politecnico di Milano, the University of Salford in Manchester, Goa Institute from India, Baltic Management Institute in Vilnius and Brussels, HEC in Paris, the Management Center in Innsbruck, and Zicklin School of Business, Baruch College, New York City University. Today, the inspirational lecture will be delivered by Mr. Aleksander Grzeszczak, representing our school. Alex lives in London and for the past 10 years has been involved in an investment fund focused on emerging markets, particularly in Southeastern Europe. He's currently executing business plans, restructuring the operation companies, and acquiring and selling assets. He's also a finance faculty member at Judge Business School, Cambridge University, and Warsaw University of Technology Business School Executive MBA lecturer. The topic he's delivering today is a new look at investors and their returns. Before I will pass the stage to Alex, I would like to take this opportunity to invite you to the next inspirational lecture, which will be delivered on 23rd of November by Dr. Pak Vick from our partner institution, the University of Salford in Manchester, Salford Business School. The topic of the lecture will be, is there a right level of financial inclusion for households? A critical review of existing theory and evidence. You will, of course, get an invitation to this lecture soon. Now, I would like to wish you a good time with Alex Grzeszczak. After the lecture, you will be invited to ask questions on chat. Alex, you are more than welcome to start your lecture.
Thank you very much. Thank you for inviting me to deliver this sample lecture. What I'd like to talk about today is a topic which, to quite large extent, is perhaps not fully or perhaps misunderstood as well by several students that I usually run into. I want to talk about returns. I want to talk about investors. We'd like to sort of give you a slightly new, different look at returns. So first of all, I'd like you to sort of mentally ask yourself a question. I mean, if we had a communication two-way on this webinar, I would ask you to sort of answer one particular question. But I'll ask you that question, and then I'll give you some of the most common answers that I typically get, which then lead to a certain level of misunderstanding about returns. So here's a basic question. If I was to tell you one word, investor, who am I talking about? Have you ever paused and thought, who is he asking about if I say investor? Can you think of a name? Can you think of a noun? Can you think of an adjective? What's behind the facade of investor? And let me tell you the answers that I typically get from my students. You know, I usually, in some of my lectures, I typically give students a tiny little piece of paper, and then I ask them, I'll give you 10 seconds to write on that piece of paper, what's the first thing that comes to your mind whenever I say to you, invest? So about 1/3 of my students always write Warren Buffett, Bill Ackman. Another half of my students write shareholders or providers of capital, or even things like, venture capital, early stage investing. But what's the point? The point is that vast majority of my investors, vast majority of my students will always give me an answer that essentially implies that we're talking about shareholders. And I bet you the first thing that you thought of when I just asked you that question right now, who am I talking about when I say investor? You thought, well, who else? It's got to be shareholders. Well, if this is the way you think about investors, then you are very likely to do the following. You're very likely to put an equality sign between, let me just write it out, investor equals shareholder. And if that's how you think about investors, then no kidding, students have difficulty understanding capital structure. Students sometimes misunderstand what it means to do comparable based valuation. That's because in their mind, investor by definition equals shareholder. I was one of those many years ago when I was in business school. That's what I was taught, and that's what I remember. Investor by definition equals shareholder. Who else could it be? Well, and that's the point of this lecture. Because the first thing in order to properly understand returns is to get rid of this notion. It's to actually, cross it out. It's to cross it out. It's to actually take this, let me actually, manually draw this. Let me just cross it out in perhaps a different color. Investor is not just a shareholder. That's the whole idea. We're going to come up with a whole host of other potential investors. Look, I just added several lines here. So investor is not just a shareholder. If this is how you're thinking about investing, then perhaps you'll be able to understand this very basic metric, return on equity. And what is return on equity? Well, we know what it is. The definition of it is net income over equity that's been invested. Net income, I sometimes ask my students, why is it net income? And then I see those empty faces. Why is it net income? Well, because somebody said it's net income. Well, the reason why it's net income, because net income is the bottom of the income statement, and that's, to me, leftover value. When you run a company, you first have to generate revenues, then you run the expenses and all of that, and down the bottom of the income statement, you have the leftovers. Leftovers belong to those who are equity investors. And by the way, in a minute, we shall extend this list of investors to include not just, and by the way, what you probably thought of, common shareholders. There is also others. So the point of talking about investors, to the point of talking about returns, first of all, I guess the first thing you will hopefully remember after this little short lecture is that next time somebody asks you investors or somebody talks to you about investors, the first reasonable question to ask would be specific. Which investor are you talking about? Because guess what? A common shareholder is only one of them. There is others. As you probably know, if I was to draw this line between risk and reward, that thing looks like this. Guess what? There's about 8 billion people sitting on this line. Some are very sort of, boring individuals with very little in terms of expected returns. Yeah, they would be probably here. Then on the other extreme of this line would be gamblers. That's where they are, those who seek risk in order to generate high returns. So when I say to you, common shareholder, as you probably thought of when I say who is an investor, well, immediately we're talking about these people. But what about all these others that are sitting on any part of this line? As I said, 8 billion people in the world who all invest or perhaps seek ways to generate returns. Some of them are extreme shareholders, extreme gamblers, some of them in between, some of them down here. What dictates where we are on this line? If I was to ask you today where you are on this line, I would probably would expect that some of you are here, some of you are over there, some of you are there, and so on and so on. When I was much younger, I would have been here. Today, I'm probably somewhere there on this line. What determines where we are on this line? What determines what kind of risk and reward we all look for as a personal choice? Well, there are a few things. First of all, studies have been done. One of the most studied phenomena in finance. What determines where we are on this line? Well, first of all, it's gender. You would not be surprised that men take more risk on average. That's one. Age is the other. No surprising. Next time you watch one of those movies where you see trading platforms on New York Stock Exchange, what you'll see is young males, because that's when they seek risk. That's where they are, the pure gamblers. So with age, people typically go down this line. Gender in general, men, women, again, I told you, men typically take risk, and social background. Perhaps you've heard the following saying that most of the millionaires and billionaires in America are either immigrants or children of immigrants. Well, why is that? Well, that's because people who come from social backgrounds of have-nots tend to take more risk. And if you tend to take more risk, chances are, if you have a diversified portfolio, you could probably expect higher returns. So these are three main phenomena that drive our choice of where we are on this line. Now, common shareholders is one. And for the common shareholder, we just calculated the metric of return percentage. Return on equity. Equity capital invested, that's their capital invested, and the leftover upside which accrues to common shareholders. So this is what they get. This is what economically belongs to them. This is their invested capital. Makes perfect sense to calculate return on equity. By the way, let's be clear, common equity. Common equity, those that sit at the very end of the line when time comes to restructure the company or when the company goes through difficulty. So that's only one group of investors. Well, let me start populating this. And by the way, why is it that most of the time when we say investor, we think about shareholder, and not only just shareholder, but a common shareholder? Why is that? Have you ever thought about this? Well, guess what? I thought about it. And it comes down to media. I mean, particularly based on my experience, it comes down to American media. As you probably know, America loves the winner. So America, well, what about you, Mr. Low risk, low return investor? How much did you make last year? 3%? Oh, yes, we want to talk to you on television. Probably not. No chance of you getting invited onto Bloomberg Television or on CNBC, because America loves the winner. America wants to talk to those who win big and lose big. If you lost big, if you made big, as long as you did it in style, that's the people we want to talk to. That's what you see in financial media. So we've been preconditioned to think of it that way. You want a proof? I'll give you a proof. How many of you know who the fastest man on earth is? Well, that's Usain Bolt, of course. I'm sure you thought about it. Everybody knows this. You may not remember when that happened. You may not remember, what Olympics, which race, and so on. But everybody knows there must have been a race when he broke the world record. And yes, of course, there was a race. And everybody knows, and their children, everybody knows that Usain Bolt is the fastest man on earth. But did you know, and I bet you almost none of you knew, that the guy who came second in that very race also broke a record? You probably didn't know that. Well, it was not a world record that he broke, but he became the fastest American ever. And, one would have thought at least that should carry some, celebrity status in the American media, no way. Nobody wanted to talk Mr. Number Two. They all wanted to talk to the best. There you go. It's because of media, we've been preconditioned us into this thinking. Investor, by definition, equals shareholder. So let's not do that. Let's scratch that idea and let's start by listing investors. The first one, yes, shareholder is one of them. Common shareholder is one of them. What about next one? Have you thought about preferred shares? Preferred equity? 10% of American corporates have preferred shareholders. Who are these people? Well, guess what? Risk reward adjusted. They're sitting probably somewhere here. So they have a lower risk expectation, lower risk appetite, and a lower risk expectation. Well, what is their return? Well, they do get something. It's a very different class of investors. Net income is not what belongs to them. If a company like Pfizer develops a new vaccine and suddenly there's boatloads of money to be divvied up, they'll get not $1 more. All of these will accrue to common shareholders. So already, as you can see, we have common shareholders, we have preferred shareholders. Let's keep going. There's other types of investors. Well, what about people sort of middle of the way? Have you heard of convertible instruments? Sure you have. Have you heard of mezzanine instruments? Mezzanine investors? These are people who also sit on this line and they have a different risk profile, different risk appetite, and so on. And finally, as I go down the list and keep on including what? Subordinated debt. Debt is creditor and investor. Wow. Maybe after 15 minutes of me talking about it, you are likely going to say, well, maybe a creditor is an investor. Here's the facial expression I get from my students when I almost have to force them to accept that a creditor or lender or debt holder is an investor. Here's what they look like. What? What's he trying to tell us? That's right, because they've been preconditioned to think about common shareholder purely as the investor in their mind. Well, there you have subordinated creditor. He's probably here somewhere. Well, then there is senior creditor as well, senior debt. Where are we here? That's right, maybe down here. So look, we've identified 1, 2, 3, 4, 5, at least 6 different general. And by the way, there's plenty of more in between because this entire universe of investors is a continuum. It's a spectrum. It's not some sort of a discrete function. So already we have identified a number of different types of investors. Okay, so let's talk about returns now, because we can calculate returns to shareholders. Well, let's do it again. Returns to shareholders are calculated by what? Net income on top and then common equity down the bottom, because net income belongs to common equity. Okay, so fine. Look what I'm going to do. I'm going now to draw a little rectangle. We have ROE. And what are we going to do now? We're going to start with that number. We're going to start with this function called ROE, and we are going to derive from scratch. You may remember, if you were in business school, at some point they taught you about return on invested capital. And then you're given a definition. Here's what it is. Maybe you've heard that. I'll show you what it is. But what we're going to do, we're going to derive it from scratch. So if return on equity is a percentage unit, this is now, let's together derive what is called return on invested capital. I'm sure you've heard of this. Return on invested capital. Now, it already will help if I give you a bit of a hint, and maybe together mentally we can change a little bit the name of this definition. And let's not call it return on invested capital. Let's call it a return on all invested capital. Now you're thinking about others. It's not just the gamblers. There is other investors. So let's derive return on invested capital together. So what do we have? On the bottom, we have the investor type. On the top, we have what is that he or she gets. That's the upside, that's the capital base. So if I start with common equity return, what if I just keep on building and adding elements to it? And then maybe together we can derive from very scratch return on invested capital. So yeah, let's go back. What was the second group of investors? Preferred equity. Shall we add these? Let's add them. Preferred equity to the bottom of this equation. Well, the next question is, what is that they get as upside? What do they get? We know what they get. Did they get any of that? None of that. They only get what is called preferred dividends. Preferred dividends. That's all they get. That's their risk profile. That's their upside, and so on. Let's keep going. Let's add more investors. Well, the next one I saw on my little list was a convertible instrument. What is a convertible instrument? It's either a synthetic convertible. So, I mean, mezzanine and convertible, by the way, very similar. Mezzanine is what? A synthetic convertible, which is what? A little bit of equity, a little bit of credit. Or convertible, which is what? Either debt, credit, or it can be converted into equity. So if I simply add now debt to this equation, well, there it is. The gamblers, the semi-gamblers, and then with the low risk return profile, what is it they get? What do creditors get? Well, creditors get interest. So interest expense from the income statement is their upside. And then we could extend that equation even further. We are just doing a sort of a little bit more than your academic approximation, which is probably what you've seen in many textbooks, which is this. ROIC is debt plus equity on the bottom, and then on top it's EBIT 1 minus T. I'm sure you've seen that. That's what I learned about return on invested capital. Ask me how I derived it. I couldn't tell you, but today I'll show you how to start from scratch and then see what it is. It's a academic simplification of a proper equation. Let's add one final thing, and that's going to be a minus. And that minus is going to be cash. And if we deduct cash, well, then we better deduct interest income on cash. I could have put an and here and here. Why do we deduct cash? Because cash, I mean, we do understand some cash is necessary for operational reasons, but typically cash, like the $200 billion of cash sitting on Apple's balance sheet, that is not cash that it's needed. Cash that's sitting idle, doing nothing in terms of generating new profitable returns. Cash is the opposite of debt. That's the simplistic equation. From now on until the end of your finance careers, you'll always think economically about cash as the opposite of debt. So the way we think about debt is in terms of net debt. If I borrowed $1 million today, and now I owe $1 million, and I have that $1 million of cash, well, accounting-wise, I'm indebted, but economically, I'm not. So that's the way we want to think about it. So notice what we just did. We derived from scratch return on invested capital equation, starting with ROE. Now let me put that into a box. Because now if I put this into a box, I get this. And what we have done is we started with return on equity and we derived, I mean, by the way, there are still other elements in this equation, but that's not the purpose of today's lecture. We definitely added at least 2 other big groups of investors. All of creditors are here, all of interest is there, preferred shareholders as well, and therefore preferred dividends. For each source of capital, there is a mapping upside on the top of this equation. The logic is impeccable. So now let me show you, why from this we then could end up with this academic simplification? Well, if you assume that most American corporates do not have preferred shareholders, less than 10% of corporates do. So what we can do is we can eliminate this to simplify them. And then if you assume that vast majority of companies do not have spare cash, then we can eliminate that. So now look, suddenly our ROIC equation looks like our academic simplification. I have equity and debt on the bottom, equity and debt on the bottom. And in the next numerical example, which I'll share with you, you will see that any time at all, net income plus interest expense, I'm going to make this 1 minus T adjustment. I'll show it to you in a second. This will always equal to EBIT times 1 minus T. So it's not like somebody came up with that. This came from here. It's nothing but a simplification of a proper, almost fully developed ROIC equation. Good. Another way to think about it, another way that I typically explain capital structure, because that's what we're talking about. Capital structure, meaning where is the capital coming from? Common shareholders, preferred shareholders, creditors, and so on. Another good way to think about it, which I typically use, is to think about a boat. Or for me, since I grew up in Canada, it's going to be a canoe. So let me actually draw a nice little canoe for you. So my little canoe looks like this. And guess what? Let's draw capital structure now. Because who sits at the front of the boat? It's the management team. Management team is doing and giving direction to the company. So management team sits right in front of the boat. Who sits right behind the management team? Well, who sits right here and then obviously leans forward and says to the management, please don't lose my money? Well, we know who those are. Senior credit. Senior credit sits on the second bench in my boat. Let's continue. Subordinated credit will be sitting on the next bench, and continue. Maybe we're going to have some, high yield bonds in a company structure. Great. Keep going. Mezzanine investors. Fantastic. Some of convertibles. Middle of the road. Finally, we get to the last two groups. Preferred equity. And you tell me where the gamblers sit in that boat. Common equity. That's the way you want to think about capital structure. Notice, each type of investor sitting in that boat is sitting on its own dedicated bench. Do you think they like each other? No, they don't. Because they care about their own particular returns. Well, let's ask common shareholders, what do they care about? Well, they care about ROE. Because for them, a return on equity is what accrues to them. ROE is the return on common equity. And that is important to these guys. Now, watch this. Who gives direction to the company and who chooses the management team? Well, guess what? Common shareholders choose the management team. Common shareholders only influence the selection of management and what the management does. Common shareholders have a right to influence what management does. Well, guess what? They will do it in order to what? To drive their returns on equity. And obviously, they want high returns on equity. Guess what? There are two ways for common shareholders to get value. One way is to give excellent direction into what the company is doing. Performance, new projects, value creation. That's one way. What about a second way? Is there another way? Absolutely there is. If they could simply steal value from anybody in front of them, it would not be a question of whether, it would be a question of time. Thank God these people, every single one of them, thank God they sit on their own benches holding a piece of paper in their hands. And that's called a credit agreement. This is how they protect their interest. Thank God they have legal recourse if any interest or principal is not paid back to them on time. Because if they didn't, it would not be a question, as I said, of if, it would just be a question of time. We've had historically many examples of actually common shareholders grabbing value from, broadly speaking, creditors in front of them. One famous case, RJR Nabisco. Nabisco buyout. Go back, look it up, Google. See what happened in RJR Nabisco when company went through a levered buyout, meaning what? They put tons of debt into the boat. The boat became heavy. And guess what? ROE went up. So value was lost by creditors. All of that value accrued to shareholders. So good. Think of this boat as an example of capital structure. Each different type of investor sitting separately in a different location, from the least risky to the most risky. When that boat is supposed to go under, if it's called bankruptcy, it would go down this way first. But as you know, if we're to be shareholders underwater first, well, they're not actually going to try to help you. Oh, no, I'm going to hold on to you. You stay afloat. I'm just going to drown. No, they will have an incentive to pull the entire boat down with them. So we learned something about return on equity. And given our derivation of this metric, return on invested capital, we'll check it out. What is now return on invested capital? Return on invested capital, by looking at this picture, is the return on the entire boat. That's the way you want to think about it. Return on all of capital, all of these sources of capital, that's return on all of invested capital. Whereas return on equity is just the return to this particular group of investors called common shareholders. You want another example? Let me give you one more. I'm sure if you go back to your high school times, I remember I go back to my high school times. I'm sure you went on a bus trip somewhere, to a museum, to another town, or maybe to Florida or something. If you went on a bus tour somewhere with your classmates, you tell me where the boring people in your class sat on the bus. And I tell you where they sat, probably right behind the driver. And where was the party central? Probably at the end of the bus. So that's the way you want to think about it. Either the bus or the boat, if you want to have a better understanding of returns. Now, one more thing. Let me now go back. I only have 2 slides that I want to share with you. Let's do a very brief numerical calculation. First example is on the next page. Okay, go down. That's it. Actually, this page first. Let's look at an example. I have a company that has the following revenues. And it's, as you can see, it's one and the same company under 2 different scenarios of who's sitting in the boat. So if I have identical revenues, identical expenses, there is my EBIT, 1667. But if I have in that boat only shareholders and nobody sitting in front, well, guess what? If there is no debt, there is no interest. So this is 0. Profit before tax, same number. Give me 40%. Of course, it works for any of these percentages. Take 667 away. There's my net profit after tax. So now let's calculate the returns. If I calculate the return on the last bench, well, it's 1,000 divided by 10. There's your 10%. And given that there is nobody in front in the boat, well, no kidding, return on equity will be equal to return on invested capital. When there is no other investors but shareholders, these two will be the same. But now let's look at the other version of it. Here I have 50-50. Broadly speaking, we simplified that presentation, just credit and equity. So if I have debt holders to whom I have to pay interest at 6%, there's your interest expense. Profit before tax changed. And now my tax changed. And my net income is different. So now look, let's calculate ROE. 820 over 5, and there's my ROE. That's gone up. If I now look at the return on the entire boat, well, in the boat, there's still 10,000. So let's calculate that. Nay, 820 is the upside to shareholders. Here it is. 300 is the creditor's upside. That's what they got in interest, 300. Here it is. But now guess what? Just because of this, company saved on taxes. Just because of that. So company saved on taxes. What was their real cost to that? Was not 300. The real cost to that was this minus whatever tax savings. There it is, 120. Add it all up. Magic happens. 10%, 10%. So what are the two things that are important in this presentation? ROE went up, not because of operational reasons, but purely because there is more debt. This fact that this is different, well, let me go to the next handout. Just the fact that this is different, ROE went up, not because of operations, but because of leverage. This gave rise to a totally huge financial market called leverage buyouts. So LBOs exist because exactly this relationship. But then there is something else, which is very important. ROIC never changed. And 10% and 10%. This gives rise to a totally huge, another type of financial, practice, which is valuation. Multiples-based valuation, firm value multiples-based valuation. What investment bankers and private equity investors do every single day as bread and butter comes exactly because ROIC never changed. Now, one more thing I'd like to do is to calculate the third metric that you're probably familiar with, ROA. So let me go back to my whiteboard. If we just keep simplified version of this equation, there is my ROE. ROE equals net income over equity. That's one. And we know what ROIC is, simplified. Net income plus interest expense, 1 minus T. That's right. Which is, sum it up, it's the same as EBIT 1 minus T. Over what? Equity plus debt. Now let me show you the other metric. And maybe you've already noticed. The other metric we typically also are familiar with is ROA. Well, what is ROA? Well, maybe you've seen this definition. It's net income over assets. Well, let's draw a balance sheet. A balance sheet has assets. Here they are. And equal to its size is the other side of the balance sheet where we have what? Broadly speaking, debt and equity. So let me rewrite it. If this is the definition, let me rewrite it. Net income over equity plus debt. Wow. Only after you're familiar with the boat, only after you're familiar with this equation, maybe you would have noticed something. Based on what we've talked about today, something's missing here. How can I even relate upside to one group? Because that's what that is. Net income is upside to this group. How can I even logically relate upside to one group with capital provided by two? It makes no sense. What? Debt doesn't cost? Well, how can I? Well, there you see it. Mixing apples and potatoes. Net income belongs to shareholders. As if what? Credit was for free? So in terms of measuring returns, return on asset, useless. We can actually calculate in our example the return on asset. For each case, it'll be different. And then you don't know what it tells you. The fact that ROE changed told me something. The fact that ROIC didn't also told me a lot. But the fact that ROA is going to be different, well, you don't know because somebody put debt on it, or maybe performance went up. I don't know. Something's missing. Credit is not free. I only know one bank. I only know one bank where I can get money for free, and that's called the bank of the grandmother. Typically, other credit, if you borrow money, there has to be interest to be paid on it. Whereas ROA, I don't know, somebody came up with this. You know, every now and then we use it as a metric of return. Whose return are you measuring? You're measuring shareholder return by dividing it their upside across capital provided by all. Nonsensical. As a metric of return, useless. Good. So a couple of things as a summary of our discussion today. Number one, from here, we learn something about investors. Next time somebody says investor, be specific. Tell me who you're talking about. Are you talking about him or her, or who are you talking about? Because each one is part of the capital structure, each one thinking about his or her own returns. Secondly, we learn something massive about the fact that ROE changes when the composition of the boat changes. We learned something that ROIC does not. Well, why should it? Return on the boat should be the same regardless where these investors sit in the boat as a total. And then finally, we learned something about ROA as it being a useless metric when it comes to measuring investors, whose investors' returns. Thank you very much. If you've got questions, I'll be happy to answer. There seem to be no questions at this moment. Thank you for your attention. I don't know, maybe the IT person will give us. Good. Thank you very much for your attention.